I would have thought the markets would be up today. I mean, we've seen, getting closer to a Brexit deal. We've seen pretty good earnings out of the companies that have reported, mostly financials. Progress, generally over the last couple of weeks towards, some sort of, maybe baby trade resolution with China. I would have thought this would cause a little bit more short-term tailwinds, but it does seem like the market is maybe taking a longer-term approach and saying nothing has really structurally changed here. We're going to wait for a true resolution in any of these areas before getting too excited.
And how would you say that investors should interpret these weak GDP numbers coming out of China?
Yeah, I mean, China's been slowing for years. This is a little bit slower than people expected, but this is not a hard landing for China. This isn't the bottom dropping out of the economy. It's slowing down maybe a little bit faster than people expected. So it's a trend of what's happening globally. Economies are slowing down, and you couple that with the trade wars, and you couple that with just the structural slowdown in China. I think people should be less focused on headline GDP numbers and maybe focus on more of the specific growth areas in China right now, such as looking at the retail space, looking at mobile transaction numbers, looking at internet usage, the things that are more kind of the new China and seeing how fast new China is growing rather than the entire economy.
So you run some technology funds. How important is the intellectual property issues and the forced transfer when it comes to getting an agreement done between the U.S. and China?
It's the biggest part of this trade war. You can look at some of the headline numbers around trade tariffs and agricultural buying, but that's all kind of sideline news to the concept of, how is China and the U.S. going to coexist going forward? We know that China wants to develop a domestic technology industry, whether that's social media companies, search companies, e-commerce, all of the kind of hot areas of technology right now. And if you look at the last 10, 20 years, a lot of the US-based businesses were actually complicit with giving their technology to Chinese businesses because that was the deal. They would basically give up their technology to enter this huge, very fast-growing market. Now that China's slowing down and now that the Chinese companies have kind of caught up in technological ability, U.S. companies and the U.S. government is saying, stop stealing our stuff. And it makes sense, but I think people have to understand the history of how we've almost sort of enabled this over the last decade. And now as China becomes more of a threat, companies are starting to protect their IP more, which is, I think, reasonable.
And so amid all of this geopolitical noise and all these headlines, where do you see long-term growth?
Yeah, well, we've been looking still at a lot of the different technology spaces and kind of longer-term tailwinds that we think are going to provide growth. We've been looking at a lot at fintech. Mobile payments is continuing to grow rapidly. Peer-to-peer transfers, financial software, we're seeing that as a very hot growth area. We're also looking at robotics and artificial intelligence. In a trade war where people have to reassess their entire supply chain and onshore more of that capability, we're seeing a lot of companies invest in robotics and AI as a way of keeping costs low while manufacturing in the United States.
You say that you like cloud and software as a service businesses. Given that we saw Workday this week disappoint investors, we saw Adobe get downgraded, why do you still like these businesses? Why are you still bullish on them?
Yeah, we're looking at the broader industry as a whole. We know there's going to be winners and losers. We're trying to separate kind of short-term noise from longer-term trends. If you look at cloud, one, this is recurring revenue. So companies are paying every quarter their toll to these cloud companies where they're either getting software as a service or they're using their infrastructure as a service and using these cloud-based technologies. And two, it's really sticky. When you have decided to partner with a SaaS company or with an infrastructure as a service company, it's really hard to switch. So if we look at, maybe the next year, next 2 years, we're going to see a slowdown in the broader economy. I think it's very unlikely that these cloud companies are going to see huge cuts in their revenues because it's become such an integral part of a lot of businesses. So it's a growth area, but it's also kind of protected from a downturn.
And stepping back, looking at the S&P, we are right below 3,000, and we haven't been able to really break out of that. Do you think that we're capped? Is there a ceiling, or do you think that there's more left in this rally?
I think it entirely depends on, again, what happens with earnings, what happens with Brexit, what happens with China. Right now, the markets have very much said we're kind of volatile, we're trying to shake out what's going on, but we haven't seen the markets explode up or explode down in a while. So we're actually recommending to investors to look at things that are paying yield. Because if you look at a preferred share that's paying 5-6% yield, in a sideways volatile market, that's actually a very attractive return if we don't know whether stocks are really going to appreciate more from here or not.
Well, thank you, Jay. Great conversation.